Good morning, everyone. My name is Chris Markovic. We'll get started in a moment. We're just waiting for our audience room to fill up. Thank you for joining us. Good morning, everyone, and thank you for joining us for the PMA-CIBC Summit Series. My name is Chris Markovic, CEO of PMA Brethour. This morning is our first episode of season 3 of our series, and we're so very pleased to open this session with Benjamin Tal, the Deputy Chief Economist from CIBC Capital Markets. Thank you, Ben, for your continued support of our program. Before we get started with our program, we acknowledge the land that we are meeting on is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabeg, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse nations, Inuit and Métis. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. We're grateful to have this opportunity to work on this land, and by doing so, we give our respect to its first inhabitants. Because our audience today is national, if you are joining us from outside of the Toronto area, I encourage you to learn more about the traditional territories where you live, learn, and work. So welcome, my name is Chris Markovic, and on behalf of PMA Brethour Realty Group, CIBC, our title sponsor, and our media partner, McEwitt, we are thrilled to have you all join us. I'm pleased to introduce Andy Brethour, who will bring us up to speed with a quick market commentary and his remarks. Then we will go to Ben Tal for his presentation. Please put your Q&A and your questions into the Q&A box. We will be monitoring them, and we will have a Q&A session at the end after Ben's comments. Over to you, Andy.
Thank you, Chris, very much. And I'm thrilled to be here with you this morning. What an amazing time this is. This is our 3rd season now of the kind of Zoom approach, having adapted back in literally the early part of 2020 to a Zoom outreach and a variety of subjects. And what's coming over the ensuing year is really, really exciting and some very powerful subjects to be reviewed. Access to this available on our website if you want to review any of the programs that are now nearly 20 of them are really quite remarkable and a great resource base. Well, let me just say that I entered 2022 in a very positive frame of mind. I'm still positive. I'm still part of PMA in my DNA, but clearly I began the year with kind of a thinking that we were in a year of transition from this COVID calamity. I entered the year doing a major piece for the Housing Task Force and some background material that we've been putting out regularly, and we formalized that in written commentary and made a presentation to the task force. It was really part of our focus in December and January. We had a tremendous session just a week ago with our team, all the sales team managers, on how to deal with rising prices, the inflationary pressures on the housing market, how to maintain a consumer experience that is the best that it can be, how to deal with mortgage approvals. That became, and CBIC, Sherry Speakman, helped us tremendously on a rejuvenation, re-education of the mortgage approval process. And I instill upon all of you to bury yourself in that, because that's going to be a major challenge as we go forward. Those were our kind of focuses in January, and then suddenly into February of 2022, the world went upside down. And from the really 3 rather catastrophic events, one being, of course, the Freedom Convoy and its implications, putting some severe strain and perhaps stain on our reputation throughout the world in Canada on how this was dealt with. the imposition of the War Measures Act, modified to the Emergencies Act, and the implication of that, enacted by Parliament on Monday and removed yesterday. So quite amazing, really, the kind of implication of that. And I think that, there was a vote to be held in the Senate yesterday. And of course, that may have been the turning point of why our prime minister removed it. Thank goodness that he did. It was a draconian law, probably overextended. But the people are angry. There's a kind of underlying dissatisfaction that came into the marketplace in 2022 that we haven't felt before. And I think it's the hangover of COVID for 2 years of calamity heading into a third. And that's kind of an underlying issue within the marketplace that's going to raise its head again as we go forward in 22. So watch for this. This is an unusual circumstance that may, in fact, trigger certain reactions that we're not used to or haven't experienced before. And then, of course, the emergency measures application was contagious and declared by Ukraine on Monday against the Russian invasion. And of course, a real emergency in that case. And my prayers go out to the Ukrainian people. They stand very much alone, unfortunately, in the world against that Russian bear. And it's a fear factor that creeps into our everyday life, really perhaps more about the unholy world order change where Russia and China are now aligned together with Iran. And this is a very frightening period in our history, and one to watch very carefully through the next coming months as to what may or may not occur. Clearly, the third catastrophic event was inflation, and we reached the highest level at 5.1% in February that we've had in 3 decades, over 7.5% in the US. And so you've got this underlying tax that's put upon the value of our currency and our ability to see unbridled price movement. Now, these events, or these rather catastrophic events, led to a cornerstone realization of 2 things. One, our healthcare system needs to have a hard look at it, how we handle and deal with our shortfall of capacity. We're at the lowest level of acute care bed capacity in the G7, and that is really an area of tremendous concern, and highlighted through the COVID period. Secondarily, the price of oil, of course, has gone to $100 a barrel today. Will it go? Ben maybe will respond to this and we'll know better, but will it now continue to move towards $150, which is, of course, probable if China takes Taiwan in the next 30 to 60 days. The impact of oil and liquefied natural gas really comes back to the policies within Canada, where in fact we are free of supply in Alberta, which is trapped. This incredible supply in Alberta, Saskatchewan, and Western Canada, completely trapped at a time where Russia is weaponizing oil and natural gas upon Europe. And this is a really interesting period for us, and one that maybe refocuses our attention to our ability to provide that, both to be self-sufficient within Canada and to have a major export market. Russia is sitting with $680 billion in cash in the bank. And as a result, they're in fine shape, regardless of sanctions, for some time to come. So they've done that on this rapid escalation in oil prices. Well, then what about real estate? What are the impacts of these things upon our marketplace? As we looked upon it before, let me call it February the 22nd, we were seeing a first half, second half year. More of the same, let me call it. Yes, interest rates are rising, and Benjamin will tell us about how much. Consensus is running at least 4 times, maybe 6, possibly as many as 8. I think the message is clear that it's the rapidity of change, not necessarily the amount, but the rapidity that's very critical to managing any type of correction. So I know Benjamin will speak to this very specifically, but that has a direct impact upon us. The immigration levels are consistently strong. And in fact, we bounced up over, not only hit the 400,000 target, and Benjamin will tell you why, but we are targeting now 430, 450, 460 over the next 3 years. So remarkable that 20 to 25% of that lands in the GTA. It's really part of the engine that fuels our housing market. But our housing market enters 2022 with no supply. Interest rates will change the supply on the resale side. As rates go up, more housing will come to market. And that will change through the second half, but it's going to take till then for that market to change. We're currently, as we entered January, 3,400 listings on MLS. Market imbalance is 25,000. On the new housing side, just over 1,000 units, 1,100 low rise and some 7,000 or 8,000 high rise units in inventory available for sale in a market that should be close to 20,000 units in balance. So we've had no supply. And when you have a consistent level of demand and no supply, what happens to prices? Well, that's economics 101, and the way it went and the way it will continue to go. Toronto surpassed Vancouver for the very first time in January as the highest average price of housing in Canada at $1.2 million average, just above. We have the dubious distinction of being the second most unaffordable city in the world. So I just point that out as a factor that something has to change in terms of how we attack housing affordability. I think that the task force recommendations, 54 of them, are phenomenal. But we have a major thing occurring in June, and that's an election. And without making any kind of supportive remark, if you want any of those things on the task force to be implemented, and many of them are critical cornerstones to supply change, and that takes a while. It doesn't happen overnight. Then we've got to seek another term from the Ford government. But a market that is in fact lacking innovation at this moment, when the market's so hot and it's so absorptions are so good and so strong, and will continue like this through the first half, innovation becomes limited. We don't see a lot of new product design innovation. That won't happen actually until the second half, as the market begins to feel the impact of increasing rates and the slowing down of absorption that's expected into that second half. It's a bit irrational at the moment. And the Bank of Canada created a study that shows the breakdown of mortgages by intent or type, and 21% of all mortgages in Canada last year were investment driven. That's not necessarily speculative, although Bank of Canada suggested that it might be. The higher the level of speculation, the greater the fear of a more serious correction. So there's a real balancing act that has to happen through 2022 on the part of fiscal and monetary policy. And I know that Benjamin will speak to that very specifically. From our perspective in the housing game, it's really about a limited absorption coming, but not necessarily any type of collapse or correction unless rates move dramatically. And I sense that that's not going to happen. Certainly Bank of Canada, the Federal Reserve are going to be very cautious and very careful, as they normally are. That may mean, though, that particularly with these world event changes, that inflation is stubbornly higher than we've ever experienced, or at least many of the people who are listening today have experienced in their lifetimes. So it's essentially, I call it kind of good news, shaky news going forward. When you have fear in a marketplace, it creates and leads to uncertainty. Uncertainty leads to inaction. And so we've got on the horizon a slowing market, one that's likely to be more stable, one that not necessarily as frothy and irrational as we've come to experience. And I believe that's actually a really good thing. So we'll see where this goes. And I'm going to now just conclude my remarks and turn it over to Benjamin Tal, a man who really needs no introduction as deputy economist of the CIBC, but whose insightful commentary I know you will really enjoy, and who will have a really good handle on where we're going from here. If anyone does, Benjamin does. Over to you, Benjamin.
Thank you very much. I'm going to share my screen, so I'll have some pictures to show you. I hope you can see that. Listen, a lot to talk about, and there's so much uncertainty. So clearly, we have to discuss a lot of things that are going to impact directly or indirectly the market, and this market is impacted by many factors. So I'll go very quickly to discuss some issues. Let me start actually with the first item that is not here, and that's Putin. And just the other day, somebody asked me in a presentation, what do you think Putin will do? And I said, next time I have lunch with him, I will ask him. Like, give me a break. I have no clue what he will be doing. I don't think that he knows what he's going to do. I don't think that there is an end game to this madness in the Ukraine at this point. What I do know is that the market is reacting. The market is probably overreacting. I also believe, and that's reasonable, that it will take not a day or two, it will take months or maybe more than that. So it will be basically something in the background that the market will get used to it. And clearly it's inflationary, but Russia is not a superpower. The impact on the market as a whole is not very significant. So the way I see the market, and again, I'm talking about just the market here, the economy, the geopolitical issue, all of you are watching CNN, you read the newspapers, you know exactly what's happening. Economically speaking, this is not a major event. It's inflationary, but it's not something that is going to derail the global economy, just because of the fact that, again, Russia is not a superpower. It's positive for Canadian agriculture, fertilizers, energy, gold, clearly positive. So there are some positives, and that's one of the reasons why, despite the adjustment in the market today, you see that the Canadian market is actually outperforming because of the fact that we are a commodity-based economy, and that's what we are seeing now happening in the Ukraine is actually positive for commodities. So again, the market is reacting, probably overreacting, and over the next few days, weeks, it will adjust to a new situation, a new reality, and will continue forward. That's the way I see the situation. And therefore, instead of speculating what Putin will be doing, let's speculate on what we can say something about. Basically, the virus and the economy. Clearly, we have good defense, but improving offense. And the question is, from a COVID perspective, to what extent 2022 is a transition year? We'll discuss. Inflation, clearly a major factor now. We have to really discuss it seriously and see what makes sense and what doesn't. Basically, how much of it is COVID, how much of it is more than that. Where have all the workers gone? Good luck finding anybody. You cannot find people. Wages are rising, inflationary, impact on interest rates. We'll discuss. Interest rates, how fast? Crucial, how fast? Clearly, Putin is adding fuel here to the fire when it comes to inflation, and therefore the risk of interest rates rising faster, that's something that we have to discuss, because it can lead, quite frankly, to a recession in 2023, 2024. Very important to discuss. Real estate, how sensitive is the sector to higher rates? Andrew discussed two halves. I tend to agree. I think that the second half will see some significant softening in the market, and that will be a good thing. We'll discuss the demographic picture, clearly immigration, what it means for the market from a long-term perspective, and of course, market implications. So let's start and see what makes sense and what doesn't. Listen, a year ago, I was trying to capture an image that described the situation in one picture, and I found this. That was the move from 2020 to 2021. Remember, a light at the end of another tunnel? We were talking about the vaccine. We were really getting excited about the end game. The vaccine will end everything. And of course, it was not so simple. This year, early this year, I tried to capture or find another image that will capture the mood in the market. And what I did is this. It's basically the same. We see another light. The Omicron wave is coming to an end, and we see another light, and everything will be fine. We'll see. Why? because of this. What is this? Go back to grade 7 geometry. That's pi, 3.14. And pi, by the way, is the next Greek letter that comes after Omicron. You know where I'm going with that. There will be another variant. Clearly, nobody knows. If you think you cannot get a straightforward answer from an economist, try a virologist. They don't know. And we have a situation in which there will be another variant. The question is, to what extent our current and future ability to deal with it will be able to minimize the damage to the economy. We don't know yet. And the hope is that, yes, there will be a pi or something else. And by the end of this madness, we will be fluent in Greek, all of us. But what it also means, it means that our defense is getting better. There will be a pill, there will be a better vaccine, whatever it is. Maybe as a society, we will be able to function, and finally, COVID will turn into endemic as opposed to pandemic. And I think that given this kind of assumption, the economic trajectory is actually predictable. The winter is tough, and it has been tough. As we know, we might get basically negative economic growth in Canada in the first quarter, or at least flat. The spring will be better. The housing market will be very strong in the spring, I believe. The summer, economically speaking, will be on fire. And then the fourth quarter will be so-so, we'll see. Depends on the variant, because we know that there is an element of seasonality to this virus. We have seen it in the past 2 years, we know already. So that's basically more or less what I see. Therefore, it's reasonable to assume that this is a transition year. COVID will not disappear, it will be with us, but as a society, we will learn to live with it. And therefore, we are talking about economic growth of roughly 4% in 2022. I will take it. But most of it will be in the second half of the year, especially in the summer and maybe starting in the spring. This, of course, assumes that everything will be okay when it comes to hospitalization rate, because we know already, everybody knows somebody with COVID. That's not a big deal anymore. Hospitalization rate is really what counts. And as was mentioned by Andrew, this is really something that Canada does not have the advantage. When it comes to spare capacity of acute beds, we are the lowest in the OECD, with the exception of Mexico. If this is not a wake-up call to invest in healthcare, I don't know what it is. And this, of course, has major economic implications. This is basically telling you the story. For a given level of infection, a given level of hospitalization rate, the Canadian economy was much more restricted than the US economy, because we reach capacity in the healthcare system much faster. We have to shut down the economy much faster. That's basically where it is. So the availability issue is there. In Canada, it's worse, but we are opening up. Things are looking good. And there is another factor that impacts economic activity, and that's the fear factor. Just an example, Germany versus the UK. The UK is basically open. Germany, not so much. You look at restaurants, basically the same. So the fear factor is still dominating. Namely, the restaurant is open, people are not going as often as they would like to. That will change with the temperatures. As the spring arrives, I think that the fear factor will diminish, and you will see a huge increase in spending, especially on services. And that's something that will be even more significant in the summer. And that's behind the 4% GDP growth that I see in 2022. Now, we know that a lot of it has to do with cash. And a lot of it has to do with the fact that people are sitting on a mountain of cash. How much depends how you measure it. That's very important from a housing market perspective. We have a situation in which, if you look at the excess savings, basically how much income you had minus how much you consumed, we are talking about roughly $300 billion of excess savings. Now, this can be used for many things: down payment, gifting in real estate, investment in your mutual funds, stock market, whatever it is. The other line, which is the gray line, that's cash in deposits. This money can be used for actual spending. This is sitting in your checking account, collecting nothing. And this money will be used in part to accelerate spending in the summer, especially on services. And that's about $90 billion. So we have a lot of cash in the system that will stimulate the economy, but the $300 billion number that you saw or you see in the newspapers is just savings. It will not be all available for spending. a lot of it will be going to real estate, and that's exactly what we are seeing. Now, given that, we really have to discuss what's happening in the inflation front. This is the number one issue. We haven't seen this kind of numbers in a long, long time. And this is something that we have to discuss seriously. Namely, how much sleep should we lose over it? Is it a structural change in the inflationary landscape of the Canadian and the US economy? So let's start with the most important aspect, and that's clearly the supply chain issue. You know the story, but I suggest that about 70-80% of the supply chain issue is demand. Look at this chart to the left. This is a real goods consumption, basically how much goods we buy. And in 2021, we bought 4 times a regular year. So you squeeze 4 years into 1 year in terms of consumption of goods. Just to put it in perspective, this huge increase in demand is equivalent to a situation in which overnight you parachuted 75 million Americans into the US, and the minute they landed, they started to spend. That's a demand shock that we haven't seen in a long, long time. And the point that I'm making is that even a normally functioning supply system will have difficulties dealing with this demand shock. And this, of course, is not a normally functioning supply system. It's very sick. So you have a sick system trying to deal with the demand shock that we haven't seen in generation. Clearly, you will have an issue. Take COVID out of this, and you have a situation in which this disappears. So if I'm right or even semi-right, and by the end of the year, COVID will not be a major issue, and let's pray that that's the case, then this will disappear. Because it's all about COVID. And all this huge increase in spending on goods will slow down because, listen, everybody says don't underestimate the American consumer, but give me a break. How much stuff do you need? You have been consuming for 2 years goods. Why? Because services were not available. So you take this mountain of cash that you have and you're going to spend on services. The difference is that services don't have supply chain. You charge too much on your restaurants, I open a new one to compete with you. It's much easier to start a new restaurant than to establish a new manufacturing facility. So the supply curve of the service sector is much more elastic and therefore less inflationary. So you will see a move from goods to services that the hope is that it will be supportive for economic activity. It will help those struggling small businesses in the service sector, but will be less inflationary because you don't get it from China. That's one aspect. So that can be something that will disappear, we hope, by the end of the year. And the only mistake that the Bank of Canada and the Fed made is that they underestimated how long it will take to get to this point. But we'll reach this point. I refuse to believe that such a sophisticated system will not be able to go back to normal after COVID is not there. But of course, you have to assume that COVID will not be there, at least not in a way that will debase the economy. More durable inflation, I believe, might be coming from the labor market. And here we have to discuss. We have a significant difference between Canada and the US in the way we look at the labor market. First of all, people over the age of 55 in the US are exiting the market. And I believe that if you are like 65, 67, 68, and you decided during COVID to exit the market, you're not coming back. So that's labor force that was there before that is not there now. In Canada, it's not happening. The opposite is the case. People are extending their working years and delay retirement. So this is an element that we have, they don't have. And that's one of the reasons why our participation rate in the labor market is higher than in the US. That's number one. Number two is the quit rate In the US, everybody's quitting. You are all familiar with the great resignation trend. In Canada, it's not happening. You don't see an increase in the quit rate. The opposite is the case. In a recent survey in Canada, a record high number of people said that they are thinking about quitting. So in the US, they are quitting. In Canada, we are thinking about quitting. That's very Canadian. Nevertheless, it's a tight labor market that we have to discuss. But the most significant issue is this, immigration. Andrew mentioned it. I think it's a very, very important issue about, just to put things in perspective, we got about 400,000 new immigrants last year. In October 2020, the Canadian government announced that the target is 401,000. And people said, are you crazy? How can you get 400,000 during COVID? Nobody's flying. We got it. To put it in perspective, look at the chart to the right. We got 400, the US got 500,000. The last time I checked, the US is 10 times still larger than we are. So per capita, we are 6 times faster in terms of getting new immigrants. That's significant, which means that we have this labor force injection into the system that they don't. And by the way, 70% of those new immigrants arrives from Canada. What I mean by that is that they were students, they were non-permanent residents, they were in Canada already. For them, this was a change in status, not a change in address. Why? Because the Canadian government realized that they cannot get people from outside. They basically invited them to apply for a different status. And that's exactly what happened. Now, this year, I can tell you that the number will not be 70%, but it will be about 55%, which is going to be higher than it was before COVID. So the trajectory is to get more and more and more new immigrants to come from Canada. What's so unique about it? As you can see from the chart to the left, many of them are under the Canadian experience category, which means that they have some job experience. They are younger, they are more educated, they speak the language, they understand the culture, they are familiar with the labor market, they are more employable. And their propensity to buy a house is higher than before. So if we assume that a new immigrant in the past will rent for 6-7 years before buying, I suggest that this trajectory can shorten the duration. Clearly, they might choose other places to live other than Toronto or Vancouver because those cities are becoming unaffordable to them. And maybe that's a good thing because we need to see them going elsewhere, not just in the cities. But this is something that we have to understand. The Canadian immigration scene is very different than what you see in the US. And that's something that is enabling us to get more injection of employment into the system. Because people say they were already here, so they were already employed. No, no, no. They could have left. They will have left. So you can see it as a new increase in employment because they didn't leave. So they didn't create this vacancy. Their visa expired. In normal times, they would have left. So they stayed. This means that they are actually keeping this job alive. Therefore, they are helping our participation rate. That's very important. I was curious to see to what extent their skill set is consistent with what we need. And this is basically a diagram that tells you to what extent there is a alignment. And if it's linear, going straight up, then it's aligned. There is a good alignment. And you can see, generally speaking, there is, namely, the skill set that they bring is consistent with what we need. However, there are some exceptions. For example, trades, construction. We all know, and in my opinion, the number one issue facing our supply difficulties in real estate is actually labor. We need construction workers, we need trades, good luck finding. I speak to developers on a daily basis, they're telling me we cannot find people. This is a major issue. So we need trades, We need construction workers. How many did we get from new immigrants? Basically zero. Health occupations. We need nurses like oxygen. How many did we get? Zero. So we basically need to fine-tune the system in order to make sure that it's not just computer engineers, but also people that we need in health, in construction, in trade. So we have to fine-tune the system, but overall, you can see that there is a relatively good alignment, which means that, again, Canada has the advantage over the US in terms of injection of new blood into the labor market. And therefore, wages in the US are rising faster than wages in Canada because our labor supply is larger than theirs. Clearly, we see wages rising in Canada. This is not to say that we don't have wage inflation. Clearly, it's rising, will continue to rise. I hear numbers that are crazy now in terms of wage increases over the next year, but it's lower than what we see in the US. And in this environment, where you have wages in the US rising faster, inflation in the US rising faster, their labor market is more tight than ours because they don't have the supply. And they already reached pre-pandemic economic growth because of the fact that they were not as restricted. You will expect that the market will expect the Bank of Canada to be more muted than the Fed, and the Fed will go into with interest rates higher and faster. The opposite is the case. The opposite is the case. The market is now expecting the Bank of Canada to move faster and reach a terminal rate, namely when they will end raising interest rates, about 40, 50 basis points higher than what the Fed will do. It simply does not make any sense. As the Bank of Canada, why do you want to divorce yourself from the Fed and go faster and higher than the Fed with inflation in Canada below the Fed and wages rising much more slowly than what you see in the US? Simply does not make any sense. So that's something that we have to take into account. Talking about interest rates, we have to look at another thing, and that's what might protect us from inflation, because at this point, we have three sources of inflation. One is the supply chain, the other is this huge increase in consumption, and the third is the labor market. I suggest that the supply chain story will not be as dominant by the end of the year. That's assuming that COVID will become an endemic. The spending is inflationary, but it will be less inflationary because it will be shifting from goods to services, and services are less inflationary because there is more supply of them. There is no supply chain. The wage story is a different story. I think this is a structural change, and I see a situation in which labor is regaining its power. And if wages continue to rise, that can be inflationary. However, there is one thing that people are not talking about, and that's the reaction curve by corporate Canada and American companies. CEOs of companies will not just sit there and pay. They will not just see their wage cost rising and beg workers to come. They will try to do something else. And this something else is investment. Let me illustrate. Look at this. Look at the chart to the left. That's the 1990s. Wages went up notably, as you can see. What happened to inflation? Nothing. Why? Look at the chart to the right. Productivity. This was the internet revolution, and people decided, okay, you know what? Labor is too expensive. We're going to invest in high tech, in capital. We are seeing exactly the same thing now. Wages are rising, labor is becoming unavailable, very expensive, and look at the chart to the right, manufacturing technology orders rising. I believe that will continue. So you're basically substituting labor or capital for labor. Basically, you invest more in technology, less on labor, because labor is not available and it's becoming more and more expensive. That's productivity. And when productivity goes up, you protect from inflation, because the number one defense from inflation is productivity, the way we saw in the 1990s. and companies have the money to spend. You look at the cash position held by companies, it's even larger than what individuals are sitting on. And this money will be spent on dividends, on buybacks, but also on investment. If Canadian companies are not investing now, they will never invest. This is the best time to invest because you need it to maintain your profit margin, because those profit margins will be under pressure eventually. You can see that there was a significant increase in profit margins since 2000. And we know why. It was globalization that is good for profit. It was the increased pricing power of companies, the fact that labor was cheap and available. Many of those things are going to change. Labor is not so cheap, not so available, and deglobalization is happening. Deglobalization started before COVID and was accelerated during the crisis. And if globalization was disinflationary, deglobalization is definitely inflationary. I'm not talking about a full-scale deglobalization. You will still get t-shirts from China, but if you wake up during COVID and you realize that 90% of your antibiotic supply is coming from China, that's going to change. The semiconductors, we know the story. I estimate that 22% of what the Americans are buying from China now will come home eventually. That's inflationary. And as a country, we have to choose a side because we are in a Cold War. Unfortunately, now in two fronts. And Canada, we know where we are. If you're Australia, by the way, that all your security needs are coming from the US, but all your economic needs are coming from China, good luck with that. So that's going to complicate the situation. In addition, to the extent that the Russian-Ukraine situation is inflationary, that's another force. And therefore, we must discuss now interest rates and the impact on the housing market. The market is pricing 6 moves by the Fed, by the Bank of Canada, about 4 moves by the Fed this year. I think that the market is wrong. I think that the Fed and the Bank of Canada will be moving together. There is no need to basically divorce yourself from the Fed. A terminal rate of about 2.25 is reasonable. Where at 25 basis points, you go and take interest rates to 2%, 2.25, it's reasonable. The question is how quickly you do it. There are some people in the market tweeting about the possibility of the Bank of Canada raising interest rates to about 2% over the course of 12 months. To me, that would be recessionary. As I told you in the past, every economic recession was helped, if not caused, by monetary policy error. And I must admit that inflation now is complicating this story. The situation in the Ukraine is clearly complicating the story. I know that inflation will be 5, 6, 7% over the next few months. I'm not even paying attention to it because it's a given. I will start paying attention very closely to inflation in July, August, September. If this inflation is not starting to trend downward towards 3%, I will raise the probability of a recession to much higher numbers than I give it now. Because the Bank of Canada, the Fed, at the end of the day, they are human. And you raise interest rates and you don't see the impact. You raise interest rates and you don't see the impact. What do? You raise again and again and again. And eventually you overshoot. And you always know that you overshot only in retrospect. So already I suggest that the inflationary numbers that are ahead of what was expected and the situation in Russia, both are working to increase the likelihood of a recession in 2023, 2024. This is not the main case scenario. The main case scenario that interest rates will be rising over the course of 2-3 years to reach 2%. But if it happens like that, that can be recessionary because that will be a shock to the market. The enemy of the real estate market is not higher interest rates. The enemy is a rapidly rising interest rates. And when I meet with the Bank of Canada, and I meet with them very often, unfortunately, I can tell you, that's my main message. because the effectiveness of monetary policy will be a bit delayed, especially in the US, but also in Canada. Why? Because when was the last time interest rates relatively high? 2017, 2018, exactly 5 years ago. So when people are renewing the mortgages now, they actually are renewing them to lower mortgage rates than they were locked in. And on average, they have a buffer of 100 basis points before they feel the pain. So the Bank of Canada can move 100 basis points before people that are renewing the mortgage over the next 2 years will feel the pain. The people that are fully exposed are those who took mortgages in 20 and 2021. The huge increase in originations, they use those extremely low interest rates, and that's where the vulnerability is. But they are renewing in 25, 26. So there's time. So the effectiveness of monetary policy might be actually not as quick and rapid as otherwise. And that can lead to a situation in which the Bank of Canada will have to raise more and more and more to achieve something. And that can be overshooting. That's my fear. So best case scenario, the Bank of Canada will move from 25 basis points to 2% over the course of 2.5 years. The market will slow down, especially in the second half of the year, because now what's happening, as we all know, is that we are borrowing activity from the future. The activity is front-loaded. People are getting into the market because the window is closing. We all know that. So that's what's happening now. Second half of the year, the future will arrive. And the market will slow down, and that will be very healthy. Very healthy. Going into 2023. However, if interest rates rise too rapidly, that can cause a recession. And you know what happens to housing in a recession. That's a risk. That's not the main case scenario, but as people in the industry, we definitely have to think about it. So my number one variable to focus on will be inflation starting in July, August, September, and see how the market will react to it. I will stop here and see if we have time for a discussion.
Thanks, Ben. The Q&A has been growing and growing over the last little while, so we'll get started right away. I'm going to point some questions to you, and I think Andy as well. First, Ben, can you elaborate a little on to what extent the economy will be on fire in the summer? What kind of things can we see, particularly as it relates to real estate?
Yeah, I think it's actually will be more consumer spending. I do believe that the spring will be very strong. And I think that the housing market will kind of soften a bit in the summer as usually that's the case. So it will be going back to normal, because over the past 2 years, the summer was very strong because nobody was doing anything else. They were home, so they were buying houses. I think that people will be traveling. It will be a very different story, and interest rates will be high enough. So what we are going to see now is basically acceleration of activity now into the spring. I believe it will be a spring market that is relatively strong, and then we'll start slowing after the spring into the summer and definitely into the winter of late 2022.
Okay. A lot of the questions coming through are connected to inflation, interest rates, and the Ukraine, and you spoke around all of that. But we'll come back to, I think, some of the items there. Another one coming in: geopolitical issues such as the situation in Ukraine impact markets and may even drive higher inflation. How do you see this impacting any interest rate decisions in the near and long term?
At this point, we haven't changed our interest rates forecast. We have to, it will have to raise the speed at which the Bank of Canada will be raising because of the inflationary fear. However, we have to remember, we have to put things in perspective. We watch CNN, so we get a situation that, okay, that's a terrible situation, and it is. But when you just focus on the economy, the global market implications, Russia is not a superpower. Russia is a superpower in fertilizers, in agriculture, in wood. And guess what? Canada is actually competing with China. We are always number 2 or number 1. So in this sense, actually, we are benefiting. The conflict in the Ukraine, from an economic perspective, doesn't have the potential to derail the global economy, especially a global economy that is recovering from COVID. So I will not overplay this inflationary fear coming from the Ukraine. We have to put it in perspective. It's a terrible situation otherwise, but economically speaking, it's not something that will change the trajectory of interest rates globally in any significant way. And that's something that we have to keep in mind. And unfortunately, markets adjust. And the market will adjust to the new situation. I cannot tell you how long this will be there. I don't know how long Putin will be there. People are telling me it can take months, maybe more. Maybe that will be the new normal for the next year. If that's the case, the market will adjust one way or another, and it will be the new normal. That's the way I see it.
This is going to be a question for you, and Ben, jump in as well. Surrounding housing prices. Time to pull up the crystal ball. Where do you see Toronto prices going in the next 6 to 12 months, and even as far out as 24?
Well, the answer is in much of Ben's discussion on interest rates. I suspect over the next 6 months through to the summer, you're going to see a moderating movement. We won't see the same 20% per year on average that we've had over the last 5 years. That's unsustainable. Incomes can't keep up with that in terms of affordability, and let's hope they don't try to keep up. That would be another impactful issue. But effectively, you're going to see it moderate and probably level off to closer to historic levels, which certainly by the fall will be very flat. In other words, you'll be little or no movement in prices by the fall, and then the great giant question mark on recession or not, and correction, or the governor of the Bank of Canada was very careful not to call it that. He called it a reversal. I thought that was a good use of a word, and that if they got too aggressive on movement of rates, and but it's happened before. It happened in the early 90s, and we lost 40% of value across the GTA when Greenspan moved rates 300 basis points in a very short period of time, and that knocked the starch out of inflation, and it knocked the starch out of housing escalation, which had been very speculative in the late 1980s and the first part of the 90s. And so what we have to be cautionary of is speculative markets, and I think rising rates pulls that out of the game. That backs off. I think going forward by the fall, you've got a couple of interesting things, like the OSFI rules will be in demand to change. In other words, we've added 2 points on that for some time. As rates rise, perhaps that comes off. Clearly, and maybe I'll throw this back to Ben, but government spending has been we are, let me put it, a world leader. We're the highest level of government spending in the COVID period of any country in the world, per capita and against GDP. We've run our debt levels to 118% of GDP, and our spending levels annually to 60%. It's just like government spending completely out of control, which is also very inflationary. So that has to get reversed. And then LNG, I think that there's an enormous opportunity for Canada. Look what Russia's done. Russia's banked and put into their bank $680 billion to cushion their world. We should be in the same position if we could ever free up oil and natural gas in particular from Alberta, Saskatchewan. I mean, that's an amazing resource that not only would pay down debt, but would insulate us from the shocks of world prices. But and I don't think it takes very long to do it. It's it might be as quick as a year away if we really got behind a change. But that opens up a whole new can of worms on the environmental side and that debate. But I'm going to fire it over to Ben on my comment versus government spending and get a reaction to that on your question.
Yeah, I definitely agree regarding prices. I think that they might continue to rise strongly over the next few months with the market, and then I think we'll start slowing down, and I hope they will slow down. They should slow down. In fact, I will not be surprised if they reverse a little bit in the second half into 2023, and that would be a good thing. Again, the risk here is that if we go into recession, because the only thing that can derail the market is a recession. The fundamentals are too strong to just go down like that. You need something, you need a trigger. The trigger can be a recession. And even a very undersupply market can go down in a recession. We all know that. So that's something that can happen, and that's the risk that we are facing. But I suggest that the second half of the year should see prices stabilizing, and that would be a good thing. The government, in the 1980s, Margaret Thatcher said, governments are like families. They have to balance their budget, they have to pay down the debt. And I said, no. Governments are not like families because families don't have the Bank of Canada. The Bank of Canada was basically financing the government. We all know the story. The same goes for the Fed. So the question is, what does it mean? Who is going to pay down that debt? My answer is nobody. You see, governments don't pay down debt. They never. They roll it over. And they look at the debt to GDP ratio and say everything is fine, which is okay. However, clearly COVID means a significant increase in government spending as a share of GDP. Before the crisis, it was 15%. During the crisis, it went to 30%, which is crazy. 30% government spending of GDP. And now it's stabilizing, but it's stabilizing at a higher level of 17, 18, 19%. Why? We already have a national daycare system. We are modifying the EI system. That's permanent increase in spending. I just suggested that more money would be going to the healthcare system. That's a permanent change in spending. So I suggest that spending will be rising on a permanent basis relative to the size of the economy. And this means, I believe, higher taxes down the road. And that's, I think, what we're going to see.
That's a good segue into the next sort of chain of questions. I'm going to try and mash up and combine a little bit. And Ben, I'll start with you. What changes do you think we can expect to see in the near future by the government of Canada for, essentially, what does it all mean? Like, what does it mean for real estate investors in Canada today? Do you think that we could see, changes to the stress test? Let
me start with the stress test. Yeah. Let me start with the stress test. When they introduced the stress test, I had an issue with it, and I wrote a lot about it, and I discussed it with many people in Austria. I said, listen, this stress test has to be flexible. It has to reflect where the economy is, where interest rates are, because the current the way we implement it is that you get like 200, 225 basis points, regardless where interest rates are, which doesn't make sense. Now, they are saying that they're going to revisit it every year. And that's a good thing. Because when interest rates will be at 225, you will have to actually revisit the stress test and suggest a different number. And I think that's something that will happen. So it should be even more flexible, but once a year, it's flexible enough, in my opinion. But I would like to see even more on that. So that's going to change, but they're not going to eliminate it. They're just going to modify it based on where market rates are. I think that when it comes to investment, I totally agree that when it comes to people investing in the real estate market, they are not speculators, they're investors. I'm sensing, and I follow this market very closely, that over the past year, we have seen an increased share of speculations within the investment community. When I speak to the Bank of Canada, sometimes they basically use investors, speculators as the same thing. They are not. The vast majority of investors are investing for a good reason. And by the way, the more I talk to people, the more I get the same answer. And they say, I want my son, my daughter, 10 years from now, because they are kids now, to have an opportunity to stay in Toronto. And for this, I need to buy a condo now. Otherwise, it will be totally unaffordable 10 years from now. And they're probably right. That's not investment, because many of them are in negative cash flow situations. That's not normal investment. They're not replacing GIC with that. But I'm sensing that this huge increase in prices over the past year and a half has triggered a new wave of speculation. And I hope and pray that higher interest rates will get rid of them. That can be a negative factor, and it will amplify the impact of higher interest rates on the market, but that's something that I will take.
I think you're right, Ben, and we're experiencing it. And anecdotally, it's very hard for us to put a finger on a person as either a short-term speculative or a long-term investment. And we've felt more of it in the last year, where housing began to be treated more like a commodity than shelter. And that was some of the same experiences we've had historically that led to, more dramatic change in the market, more greater corrections. I don't think it's as out of control as we've seen in the past, but it certainly has risen. The other thing that you have mentioned before, and I think would be interesting to bring to the group's attention, is this really strong transfer of wealth. We've never seen, we expected it. I mean, here I am as an aging baby boomer. The transfer of wealth to the next generation is occurring today. It's not waiting. It's not as we might have expected to occur within 5 to 10 years from now. It's happening right now. Do you want to comment on that a little bit? Because that's significant, really.
Absolutely. This is the gifting aspect of the market. And we did a research on that, and we published it a month or two ago. One third of first-time home buyers are getting a gift. Another 10% of mover-uppers are getting a gift. And this gift is significant. On average, it's 80%, but $80,000, but this includes people in like PEI in those markets. If you look at Toronto, Vancouver, the gift is very significant. Just an example, the gift in Vancouver for mover-uppers, the average, $340,000. That's a gift. That's a gift. I'll take it. And what I suggest is that we have the biggest transfer of wealth in Canadian history, and it's like 3 generations. People in their 80s and 90s, their kids in their 60s, and their kids in their 20s and 30s. And this money is skipping a generation. Listen, I have another event starting now.
Oh,
I apologize. I have to run.
Benny, thank you.
I'm getting these terrible emails.
Thank you so much. Maybe we can convince you in a future session just to do a rapid fire question and answer. Again, Benny, thanks very much for your time today. Off you go to your next session. Everyone else, please stay on the line. We're gonna wrap up now with our draw courtesy of CIBC.
Happy to hang in if you want me to, Chris, on any other questions that might relate to it. I can stay for.
I'm mindful of time here, and we're already past our 12 o'clock mark. So definitely we're logging the questions, and we'll be sure to try and get them back out to the audience.
Okay, thank you very much. See you.
Thanks very much, Ben.
Bye-bye.
So for our draw, our first winner is Brett Sadowitz from Tiffany Park Homes. Brett, congratulations. CIBC will be reaching out to you directly to get your lunch gift card over to you for a free courtesy lunch, courtesy of CIBC. And our next one is Frank Sharippa from Plaza Corp. Congratulations, Frank. I'd like to thank all of our sponsors. First, CIBC and Bental, our title sponsor and industry partner, SR Law, Balcony Bliss, My Design Studio, Sagan, Smart Touch, the folks at Next Home and Buzz Home, of course, Orea and Build, and then Reliance and Westmount Project. These events wouldn't be happening if it wasn't from the support and the suggestions and episode ideas that come from you in the audience. So thank you for your support. It's because of you that that this is possible. And to our event producers, Leanne McHewitt and the team at Partnership, you guys just make it happen in behind the scenes, and thank you very, very much. So everyone, please look out for invitations for our March session, which will be coming out soon. Again, thanks so much, Ben Tal, for the time and being such a strong supporter of our series here. Have a great afternoon, everyone. Enjoy the rest of the week.